Welcome to the first home focus series of the Move IQ podcast, brought to you in association with Skipton Building Society. We're sharing all important advice for first-time buyers, and I'm joined today by Emma Jagger, who's a senior mortgage product manager at Skipton, to share information on how an income booster mortgage works. Emma, what are the options for buyers who have affordability constraints?
So one of the options is an income booster mortgage. It's also known as a joint borrower sole proprietor mortgage with many lenders. But essentially it is what it does on the tin. It boosts people's income and it allows you to put extra people on your mortgage and use their income for affordability without them actually owning the property at the end.
So they're not on the deeds, they don't have any ownership of the property, but they are involved in the mortgage?
Yeah, so at the end of it, when the mortgage is paid off, they won't own the property, but they are liable for the mortgage payments. So quite often you may see parents helping out their children where their income may be on a certain trajectory, or where they might need a bit of help from the bank of mum and dad, but without being parting with any of their cash or their savings that they might need.
So it comes into play in that situation if mum and dad, for instance, haven't got the cash, but they do have the earning capacity that would support your application.
Yes.
Yeah. How does it typically work? And I asked that in relation to a normal mortgage application.
Yeah, so it feels very similar to a normal mortgage application in the fact that you'll go through the same kind of credit searches, you'll go through the same process. And the only difference really is at the end when the solicitor is registering the title deeds, it will only be certain borrowers on the title deeds and not the additional borrowers. It's really important that those people that are going on the mortgage but not on the title deeds to actually go into that arrangement with their eyes open and get some independent legal advice. I suppose one other thing to say is that a lot of people do use their parents for this kind of mortgage, and therefore if their parents are older, maybe approaching retirement, the term that you're able to take might be limited because we're using their income for affordability and it's got to be sustainable. Sure.
So your additional borrowers are there to act as a kind of stepping stone to help?
Yeah, they certainly can. When a lender is taking it into account, they will have to assume that the additional borrowers are going to be on the mortgage for the whole duration. But quite often, people use it as a stepping stone to get onto the ladder. Their circumstances change. They may receive promotions, pay rises, and then at any time in the future, they can actually remove that the additional borrowers off the mortgage.
So if in a few years' time their borrowing capacities increased because their career has developed and their income's increased, then they can say goodbye to their income boosters.
Sure, as long as they are meeting that lender's affordability criteria, then by all means they can remove those borrowers off the mortgage.
And what are the criteria for someone thinking about offering this kind of support? What are the lenders going to be looking for?
So I think the main thing is that in the event of the main borrower or borrowers not paying the mortgage, then they will be liable for that. So it will be on their credit file, and they, if there's any kind of missed payments or anything, then it affects the additional borrower's credit file as well. So there's definitely that to consider.
Let's say somebody has 3 children and they want to try and support all 3 with this kind of a concept. Would that be possible?
In theory, it depends on whether lenders offer it and what their individual criteria is. So it's good to do your research on that, especially if people are looking to support multiple children. But a lot of it will come down to affordability at the end of the day and making sure that, they can afford all 3 of those mortgages.
Yes, so it's actually quite complicated once you get if you're trying to help several people.
Yeah, it definitely is, and you've got to consider your own individual circumstances and what you're prepared to sign up to as well.
Yeah, and just to be clear, it would go on your credit rating if you were to support somebody through this.
Yes, it would.
Yeah. And do you have any practical tips for either the main borrowers or additional borrowers that they should really be mindful of before going into this?
Yeah, I think the main thing is seeking independent legal advice, because you're essentially signing up to a mortgage. It's a big financial commitment, and it's kind of knowing what the benefits of the income booster is, as well as the considerations that you've got. And also that they are fully aware that they won't actually own the property at the end, so they'll be liable for the mortgage payments.
It's quite a big thing to ask somebody, but it's a lovely thing to be able to offer somebody if you're in a position to do so.
It's certainly another way of helping people get onto the ladder that might not have been able to normally. So any support for first-time buyers that are hoping to get on the ladder, these kind of solutions are definitely welcome in the industry.
I think it's a great way both to help you get further up the ladder, but also a great way to help somebody achieve that. I think it's awesome.
Definitely.
Thanks for joining us on this episode of Move IQ's First Home Focus podcast. We hope you found our tips and advice helpful. Remember, home ownership may be closer than you think, and we are here to support you every step of the way. So please don't forget to subscribe, rate and review our podcast so you never miss an episode. Until next time.